The trading floor opens, but the cheers never come. Screens flicker, then freeze mid-ticker. Half the listings go dark. Trading halted. Thousands of miles away in Beijing, TV anchors cut off mid-sentence as emergency broadcasts roll in. Cargo routes are suddenly marked on hold. Soybean ships vanish from tracking maps. And in New York, Treasury yields flip upside down. The traders watching know what that means. This isn't a tariff quarrel anymore. It's the moment the world's financial safety net snaps, and the Federal Reserve faces the one move it swore it would never use again: endless money creation. By nightfall, commodity desks have already traced the fallout. Beijing had pledged to buy over 12 million tons of U.S. soybeans before the year's end, and 25 million tons annually for 3 years after. Numbers meant to calm Midwest markets, but clearly framed as a truce, not a partnership. That same promise appeared in a White House release Reuters cited earlier. Yet grain traders couldn't miss the irony. Just weeks ago, China hadn't purchased a single U.S. soybean for the first time since 2018, turning instead to Brazil and Argentina at the height of America's harvest. The message was clear: when policy risk rises, buyers move instantly. Prices shifted as if by script. As whispers of tariff relief spread, Chinese importers re-entered the market, but their first calls still went to Brazil. The reason was simple: Brazilian cargoes had become cheaper and safer bets than U.S. shipments from Gulf ports. Reuters confirmed on November 3rd that the booking patterns flipped almost overnight, once freight spreads and political risk moved in Brazil's favor. Hidden beneath the soybean headlines was the real pressure point: rare earths. China agreed to suspend its strict export licensing for 1 year, while Washington froze a Commerce Department rule that would have blacklisted thousands of Chinese subsidiaries via a 50% ownership rule. That proposed change, unveiled September 29th, would have made almost any export to an affiliate subject to licensing. In practice, a ban. The U.S. pause, reported October 30th, marked a tactical ceasefire. Both sides needed breathing room before pushing deeper into an economic Cold War. Markets saw it coming. Rare earth miner stocks had already surged earlier in October, when Beijing tightened export scrutiny. Analysts reminded investors of a reality that never changes. China processes over 90% of the world's rare earths and magnets, while the U.S. runs just one active mine and relies on China for refined materials. The International Energy Agency's 2024 update confirmed it. China's dominance in magnet production exceeds 9/10 of global output, a lock on the metals powering EV motors, turbines, and high-end electronics. Trade data from Beijing told the same story. Rare earth magnet exports dropped 6% in September, while total rare earth shipments plunged 31% as new licenses took effect. Reuters called it a warning: when policy changes in Beijing, global supply either surges forward or grinds to a halt. Meanwhile, Brazil quietly tightened its grip on the soybean market. Nearly 80% of Brazil's total exports now flow to China, and in September, over 93% of its shipments went there. Reuters noted that lower production costs, favorable weather, and a weaker real kept Brazil's offers unbeatable heading into 2025. Even with America's harvest peaking, Chinese crushers saw no reason to switch suppliers. That dynamic isn't changing soon. Brazil's agriculture agency, CONAB, projected record soybean acreage into 2026, output hovering near 170 million tons. The U.S. Department of Agriculture echoed that optimism in its March outlook, signaling record yields despite regional weather swings. These forecasts shaped how traders positioned futures and how margins tightened across the globe. But on the ground, U.S. farmers are still under pressure. The USDA's Economic Research Service projected total production costs near $467 billion for 2025. Slightly above 2024 in nominal terms, but still high compared to the last 2 decades. Much of their stability comes from government payments and higher cash incomes, not cheaper inputs. The Federal Reserve, meanwhile, has begun its own quiet pivot. On October 29th, it trimmed interest rates by a quarter point to the 3.754% range, and announced that Treasury balance sheet reductions would stop by December 1st. Chair Jerome Powell warned that any further cuts were far from certain, but the signal was unmistakable. The age of tightening was ending, and the age of soft landings had begun. Right now, Washington and Beijing are both trying to buy time, not peace. The latest policy shifts in Washington tell that story clearly. The Federal Reserve has decided to recycle all maturing treasuries and redirect mortgage bond proceeds into short-term bills. At the same time, it's allowing up to $35 billion in mortgage-backed securities to quietly roll off each month. It's a careful maneuver, one meant to ease funding pressure in money markets, without committing to new large-scale purchases. Powell's language in the latest briefing gave away the intent. The Fed is trying to keep liquidity stable as cracks begin to show in labor markets and short-term funding. According to Reuters, the balance sheet tweak came after a surge in the use of the Fed's standing repo facility and a sharp drop in bank reserves, signals that the system was tightening faster than expected. The message was clear. The central bank is protecting market function even while holding a restrictive stance, but the timing was no coincidence. Companies are heading into the year's final stretch, facing higher real borrowing costs and tightening cash conditions. Meanwhile, the trade front has its own moving parts. The Busan Framework, the latest package of U.S.-China economic adjustments, included a temporary truce at sea. Washington agreed to suspend for 1 year new port fees on Chinese-linked vessels. Those charges went live back on October 14th alongside tariffs of up to 100% on certain cranes. In return, Beijing pledged to withdraw its retaliatory port measures. On paper, that sounds like a reset. But according to a White House summary relayed by Reuters on November 1st, the relief only applies to certain lanes and shipments. Freight forwarders described it as temporary breathing room, not a structural fix. The deeper issue remains the tariff maze itself. The new agreement trims parts of the combined duty stack, the older Section 301 tariffs and the more recent blanket tariff, by around 10 percentage points, with specific cuts for categories tied to fentanyl control. Yet, even after those adjustments, the effective tariff rate remains far above pre-2018 norms. That means prices for consumers and input costs for companies stay elevated. On China's side, the 1-year suspension on rare earth export limits gives symbolic relief, but it doesn't erase the underlying vulnerability. Those gaps explain why both governments are now quietly stockpiling. Reuters noted that with the U.S. pausing new export control expansions for 1 year, and China freezing its tighter licensing regime for the same period, companies on both sides have a short window to build up reserves of legacy chips and key materials. The Commerce Department's delay of its affiliates rule and Beijing's new general license framework both point to temporary détente, a ceasefire designed for inventory, not for trust. In essence, these stockpiles are a countdown, not a solution. The soybean clause proves the same point. Even with Beijing committing to expanded U.S. purchases, Chinese buyers still dominate Brazilian supply lines. Roughly 80% of Brazil's September export program went to China. Reports from KOAB and the USDA project another record Brazilian harvest, meaning China retains options no matter how much it buys from the U.S. And while trade negotiators talk about tonnage, the economics on the ground remain tight. U.S. Department of Agriculture data show production expenses stuck at record highs. Rising interest costs and labor shortages are still eating into farm margins. Without productivity gains or policy relief, higher tariffs on imported machinery, fertilizer, and components keep the pressure on. These are balance sheet realities, not political talking points. Meanwhile, the labor backdrop complicates everything. Reuters flagged August payroll growth as the weakest in 4 years, with unemployment rising to 4.3%. The share of long-term joblessness ticked higher too, a combination that usually translates into weaker discretionary spending and less pricing power for retailers. Those forces ripple straight into tariff-sensitive categories like consumer electronics and household goods. Analysts parsing the Busan Agreement see it not as a settlement, but as a timeout. Reuters' breakdown highlighted that both sides built reversibility into every clause. China's commitments on soybeans, sorghum, and timber are explicitly quantified. America's pledges on port fees and export controls are time-bound. The pause on rare earth licensing isn't a dismantling. It's a delay. The entire architecture is designed to be reset at will. Even the legal side shows limits. On November 4th, Reuters reported that administration lawyers told the Supreme Court it couldn't fully unwind the current tariff structure. That means much of the duty regime remains locked in unless the White House or Congress explicitly acts, an unlikely prospect in an election year. On the commodity front, markets are already testing the edges. Reuters' mid-October coverage linked rare earth equities directly to China's shifting export stance. A lasting pause might ease short-term tightness, but International Energy Agency data still show China dominating every critical stage of magnet production, from refining to assembly. Those magnets, not the raw ore, are what really bind electric vehicle and drone supply chains. Agriculture follows a similar pattern. The next USDA and ERS updates will determine whether Beijing's soybean promises actually drain U.S. stockpiles or simply reshuffle trade routes. ERS projections released September 3rd pegged farm expenses at roughly $467 billion, and average farm net cash income around $127,000. Numbers supported by subsidies as much as by sales. It's a safety net, not a fix. And in the background, monetary policy keeps turning the gears. Powell told Bloomberg that another rate cut in December is far from certain, even as the Fed ends its Treasury runoff on December 1st. Reuters explained that reinvesting maturing assets and redirecting MBS proceeds into bills will ease liquidity pressures without actually growing the balance sheet, but it leaves the door open for expansion if funding stress returns. When you connect the dots, the trade, tariff, and monetary adjustments all tell the same story. The Busan package trades a one-year truce in export controls and a small tariff cut for symbolic commodity deals and promises of cooperation. The Fed trades a modest rate cut and a stop to runoff for breathing space in money markets. And both Washington and Beijing trade time, not trust, through inventory. In the end, one set of numbers will decide whether this pause becomes a pivot. If China's soybean commitments turn into steady U.S. loadings even while Brazil exports record crops, the global trade balance stabilizes. If rare earth licensing remains open long enough for magnet shipments to continue, supply chains breathe again. If the Fed's reinvestment posture calms funding costs while joblessness rises, rate cuts come back on the table. But the risk is just as real. China's grip on magnet-grade production is still overwhelming. Any snapback in export licensing would hit instantly. The tariff relief is partial and temporary. Farm expenses remain high, and the Fed, cautious as ever, has made clear that December is no guarantee. All these facts lead to one quiet but unavoidable question. When the one-year clock on this fragile truce runs out, will anyone still be willing to pay the same price for more time? We'll find out soon enough. If you found this analysis useful, don't forget to like, share, and subscribe, and check out our next deep dive, now playing on your screen.